This meeting of the board is a hybrid physical virtual meeting. I would like to welcome those in the boardroom with me today. While keeping your microphones muted, please join me in the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America, to the republic which stands one nation under God, indivisible, with liberty and justice for all. It's great to see everyone this morning. So before we move to the business before the board, I'd like to take a moment to highlight some recent events and recognize several FCA members with us today. First of all, for all those in attendance, thank you for your flexibility because we did move this meeting and some of you traveled a long way, so thank you. As you know, this meeting was originally scheduled for tomorrow. However, FCA offices will be closed tomorrow as a mark of respect for our nation's 39th President, Jimmy Carter. As a farmer, President Carter understood the vital role agriculture plays in the fabric of our country. May his legacy guide us as we strive to uphold the strength and sustainability of American agriculture. Now I'd like to extend a warm welcome to some very special guests with us today. Would the Staff Development Division's Management Integration attendees please stand up to be recognized? Wonderful. Management integration is one of the final segments of the agency's examiner commissioning program and covers board and management operations in the farm credit system, including board governance, systems of internal controls, and human capital. Folks, this group before us is the future of the Office of Examination. Again, welcome to you to this important part of your training and wish you all the best. Thank you. You may sit. I'm also pleased to welcome Ben Mosley, FCA's new director for the Office of Congressional and Public Affairs. With nearly 2 decades of government relations experience, Ben has had his fingerprints on 3 farm bills from his time with the Senate Agriculture Committee and as Vice President of Government Affairs for the USA Rice Federation. Ben brings a deep understanding of farm policy and legislation. His proven track record of advancing policies that support American agriculture and rural prosperity will be an asset to FCA. Welcome, Ben. Ben joins a dedicated OCPA team, as we all know, which over the last few months has been led by its Deputy Director, Emily Yagmore. I'd like to take this opportunity to publicly thank Emily for her leadership and steadfast commitment to public service, to this agency and to our mission. Emily first joined FCA in October 2006 as a writer-editor for OCPA, and over the years has become a stalwart in this agency, helping craft our message, our voice, essentially in and out of FCA, among other notable responsibilities. On behalf of the board, thank you, Emily, for your enthusiasm, collaboration, and leadership. Board Member Hall, do you have any comments you'd like to make today?
Well, I just want to add my appreciation to Emily for all the work she's done over the past 18 years and stepping in at a time when we needed her the most, and she's always been there and a great part of this agency. I just want to add my appreciation. Thank you.
Thank you. Board Member Smith, do you have any comments?
Yes, thank you, Mr. Chairman. Whenever I think of Emily's service, I think back to the COVID days, and at certain times there was only about a handful of us running up and down these halls, but Emily was one of them, demonstrating that dedication, a true dedication to her job. And because everything went out on time, we're constantly informed on the recent developments in COVID. And again, that's when We developed a really, really good friendship back then. I cherish that. And thank you. Thank you for your service. Also understanding you examiners that there's a little, sorry you had to come into town when we had so much snow, but the Bloomington and Denver people say, what? This is nothing, right? So anyway, hope you're getting around and having a good week of it. Thank you, Mr. Chairman.
Thank you. At this time, I will ask the secretary to the board to address a few technical and protocol items.
We have a quorum. The full board is present for this meeting. Chairman Logan, Board Member Hall, and Board Member Smith. Your microphone should normally be muted except for board members and presenters. Please ensure that you have silenced any mobile devices you have with you. The virtual portion of this hybrid meeting is on Cisco WebEx. We have 2 OIT staff, Ben Rana and Victor Amaya, monitoring and managing the meeting. They will be locking this meeting and no new connections will be allowed. OIT will be advancing the slides, so you will hear presenters say, next slide. If you are an FCA or FCA staff member, you're considered a panelist. The outside visitors are considered attendees. Everyone will see the slides as they advance. If you lose connectivity in this meeting, please contact Victor Amaya. Lastly, this meeting is being recorded. The video recording of the open portion of this meeting will be posted for public viewing for a limited period of time. Chairman Logan, that concludes the technical and protocol items. We're ready to continue when you are.
Thank you. The secretary will now read an opening statement on the Government in the Sunshine Act.
This is an open Farm Credit Administration board meeting under the Government in the Sunshine Act. If anyone raises a subject that may be discussed in closed session as permitted by the Government in the Sunshine Act, Chairman Logan will entertain a motion to close the meeting.
We will now review the published meeting agenda. Is there a motion to adopt the agenda as published?
Mr. Chairman, I move to adopt the agenda as published.
I'm sorry, Jeff. Yep. Now I second that motion.
Motion has been made and seconded. Is there any further discussion on the matter? Hearing none, the secretary will record the vote on the motion.
Mr. Hall,
Aye.
Mr. Smith,
Aye.
Chairman Logan.
Aye. The motion carries. Next, we will consider whether any portions of the meeting should be closed to the public.
The agenda does not include items that we should properly discuss in closed session. I move that the entire meeting remain open.
And I second the motion.
The motion has been made and seconded. Is there any further discussion on the matter? Hearing none, the secretary will record the vote on the motion.
Mr. Smith,
Aye.
Mr. Hall,
Aye.
Chairman Logan.
Aye. The motion carries. Please turn to tab 1. The next item on the agenda is the approval of minutes as presented behind tab 1.
Sorry, I move to approve the minutes of the December 12th, 2024 regular board meeting as presented.
And I second that motion.
The motion has been made and seconded. Is there any further discussion on the matter? Hearing none, the secretary will record the vote on the motion.
Mr. Hall,
Aye.
Mr. Smith,
Aye.
Chairman Logan.
Aye. Motion carries. Please turn to tab 2. At this time, I will ask David Lewandowski and Shara Pollard of ORP to present the update on Farm Credit System funding conditions. This is an information item.
Good morning, Chairman Logan, Board Member Hall, and Board Member Smith. My name is Shara Pollard. I'm the Senior Policy Analyst with the Finance and Capital Markets team in the Office of Regulatory Policy. With me this morning is David Lewandowski, Senior Policy Analyst on the Finance and Capital Markets team. I wanted to thank you for the opportunity this morning to provide the Office of Regulatory Policy's periodic public update on the Farm Credit System's funding. Before David and I provide an update on current market funding conditions, I would like to just provide a brief background on the Farm Credit System's funding process. The Farm Credit System primarily obtains funds for its lending operations from the sale of system-wide debt securities through the Federal Farm Credit Bank's Funding Corporation, which is the fiscal agent for the 4 farm credit banks. Debt issuance must be approved by the Farm Credit Administration, subject to certain criteria. The Office of Regulatory Policy is responsible for the day-to-day operations of funding approvals and related functions. And then within that, the funding approvals team maintains a program for the timely processing of routine funding approvals. The funding team is also responsible for monitoring activities, periodic reporting, as well as other controls. At this point, David and I will now provide an update on the Farm Credit System funding conditions, which is part of our monitoring activities. And I am going to start with an overview of current financial headlines. Next slide, please. So I wanted to start off just by talking about the rate environment here in the US. As you might recall from our July 2024 funding updates, many economies were at an inflection point where inflation was starting to stabilize or decline. The US did remain somewhat cautious because there were indicators that pointed to persistent inflation. Since that time, there have been 3 rate cuts here in the US, with the most recent one on December 18th. And the federal funds target range is now 4.25% to 4.5%. At the time of the December cut, the Fed signaled that it's leaning towards holding rates steady in the future, since inflation does remain quite stubbornly above their 2% target. The US economy has also proved to be remarkably resilient, which gives the Fed some reassurance that it can stand pat without risking any undue economic damage. So as of now, Fed officials have penciled in just 2 rate cuts for next year, according to latest forecasts, and this is down from the 4 that they had projected in September. And Powell had even said that he wouldn't rule out a rate hike. Next slide, please. I did just sort of want to zoom out and look at things on a global scale for a minute. The world economy, it is projected to grow at a slightly higher pace next year as inflation does hopefully start to dampen. But I did want to highlight some of the potential hindrances to growth. Namely, shifts in tariff policies by the incoming US administration could impact growth and increase inflation. In addition, there are wide budget deficits in governments around the world, and this could also hinder growth and have an impact on funding markets. So this is just something that we're continuing to monitor as we look at system funding conditions. Next slide, please. So these are the topics that David and I are going to be discussing today. I'm going to talk about global markets, the agency debt market, system activity, and then I'll hand over to Dave to talk through yields and spreads on system debt, liquidity, and then some of the geopolitical or wild card impacts on funding conditions. Next slide, please. So here in the US, I mean, I've talked about the recent cuts in rates and the forecasts, and I just wanted to talk a little bit more about inflation and employment. The Fed is trying to strike that delicate balance between price stability and full employment. The labor market, it has shown some signs of cooling recently, with unemployment ticking up slightly, but unemployment does remain relatively low at 4.2%. Inflation, on the other hand, while it has made some progress towards the 2% objective of the Fed, there is some stickiness. The personal consumption expenditures index, which is the gauge that the Fed focuses on, was 2.4% in November, and this is versus the 2% target. These numbers, they were slightly lower than expectations, but they do suggest some uncertainty over the future path of prices. And housing and services have been sort of 2 of the key contributors, so we'll just have to wait and see if that continues. Overall, the economy is stronger than the Fed expected. So when you combine the strong economy with higher recent inflation and higher uncertainty with regards to things like tariffs, that all points to a slower forecasted pace of rate cuts. And then I wanted to touch on the treasury market as well. So treasuries are currently right around 28 trillion. This was as of November. Demand does remain strong. In recent years, there has been a slight shift in the investor base towards potentially more price-sensitive buyers. So this dynamic, coupled with the expected increase in treasury supply, could lead to increased volatility and higher yields in the treasury space. An increase in the volume of U.S. treasuries could also have a crowding out effect for agency debt. So these are things that we continue to monitor. In terms of what's happening elsewhere in the world, the European Central Bank and the Bank of England have both been gradually cutting rates, sort of in lockstep with the Fed. Their economies do face different challenges than the US economy, so it'll be interesting to see what the path of their rate cuts is going forward. The impact from the pandemic, for example, was a little bit different in Europe, as well as the conflicts in Ukraine and the Middle East. The UK recently passed a new budget, and this has cast some uncertainty around future inflation and economic growth. In terms of Japan, they're sort of on the other end of the spectrum where they're looking to raise rates. They did keep them steady in their December meeting, even though the economy is moving in line with expectations. They again cited concerns over the potential impact from U.S. tariffs. China continues to be weighed down by their struggling real estate sector. Potential trade tensions with the U.S. could exacerbate their economic recovery. The government has indicated, though, that they plan to provide further support to the economy. Excuse me. Next. Oh, sorry, not yet. So geopolitical impacts. David's going to talk about this more in his section, but I did just want to mention that there could be some potential upside risk to inflation from, for example, the regional conflicts in the Middle East and Ukraine. So we're going to keep an eye on that. But Dave will talk more about that later. Next slide, please. So this slide shows the trend in 10-year yields for the US, Canada, the UK, France, Germany, Japan, and China from December of 2022 to December of 2024. Since our last update in July, yields did start to initially decrease, but they've since moved back up slightly, just given the uncertainty around Fed rate cuts and inflationary pressures in 2025. Next slide, please. So as you recall, the system debt ratings are linked to that of the US government. There haven't been any changes in either ratings or outlook since our last funding update in July. Fitch did reaffirm its rating in August of 2024. And Moody's, if you recall, they moved their outlook to negative in November of 2023, and this was largely reflective of concerns over the deficit, as well as some political polarization around things such as, working through the government shutdown and the debt ceiling. So we'll have to see how the debt ceiling negotiations play out in the next couple of months. As a reminder, the debt limit was suspended in June of 2023 through the 1st of this year. So it resumed again on January 2nd. The U.S. is expected to reach that limit sometime in mid to late January. That's sort of a moving target. But the Treasury should be able to pay its bills through the middle of this year. So again, something that we'll keep an eye on. Next slide, please. So not much has changed with the overall picture in terms of agency debt issuance since our July update. The Farm Credit System is still ranked second after the FHLB. And just as an update through year end, Farm Credit System debt issuance was $298.5 billion through the end of December. So our debt continues to be well received by investors, and this is because of obviously our GSE status, conservative business practices, and then I talked about this in July, but just the consistency in our financial results. And I will talk more about system funding conditions in a couple slides. Next slide, please. So the overall size of the GSE market hasn't changed substantially since our July funding update, and it's still right there around 2 trillion. The system is again second to FHLB with around 20% of the GSE market. And again, just as an update through year end, system debt was 448 billion. I will just mention with regards to Fannie and Freddie, there's, obviously been news regarding the conservatorship and what's going to happen with that. I mean, I think that could take a couple of years to play out, but that could have an impact on the overall level of their debt going forward. Next slide, please. So similar to the trends that I highlighted back in our July funding update, the shift from discount notes to floating rate debt continues, and that in particular to SOFR debt. This is largely a reflection of market demand as well as bank strategies, and David will touch on this a bit more in his slides. I did just want to highlight that funding conditions do remain good for the system. There's strong demand and liquidity for farm credit securities. Spreads for system debt remain favorable, especially in the 5-year maturity or less range. For longer term maturities and callable debt, spreads have improved, but there has been, premiums do continue to be somewhat sizable, and this is due to the persistent debt market volatility. Again, David will get into that in a bit more detail. Our debt spreads also remain largely in line with, if not more preferable than, the spreads of other GSE issuances. Next slide, please. So there haven't been any changes in the dealer group since our last funding update in July. Just as a reminder, the dealer group is for the primary distribution as well as secondary market support of system debts. And then the lead dealers are minority, women, and disabled veteran-owned firms. But no changes there since July. And at this point, I'm going to turn over to David, who's going to discuss our debt programs, system debt yields and spreads, as well as system liquidity.
Thank you, Shara. Morning, Chairman Logan, Board Member Hall, Board Member Smith, and good morning to all the new examiners over there. It pains me to think how long ago that was for me. One thing I'd ask you right now is, do you happen to have ever seen The Wolf of Wall Street? Okay. Do you remember what the best part of that movie was? The regulators won at the end, right? So you're on the right side. So with that, we'll go into some more detail on a pivotal part of the system, and that's the funding mechanism that provides most of the funds for the system to operate. Next slide, please. This is the discount note distribution for the year. You can see that the prevalent C of that is in the state and local and investment managers are the primary buyers of that particular debt security. Although, as you saw on Char's slide, it's not the largest outstanding. It is one of the most active programs that's utilized by the system to obtain the funds on a daily basis, generally speaking. And you can see that the state and locals and investment managers are prominent in this regard, and we'll talk about some of the lead dealers as well later on. They do utilize this program as well. This is fairly representative of the other products, although in the case of the floater space, that is another prominent debt security being used that you just saw with Char's presentation. That basically would be more in the investment managers. That currently, right now, there's close to $7 trillion in money markets. So that money's looking for a home, and the discount notes that the system has is one way, but also the floater securities is another. Next slide, please. Just to go review some of the things that's processes that are used to sell securities. We have the Dutch auction, which is similar to what the Treasury uses. Again, bullets have been a little less pronounced since July and for the whole year as well. But the spreads that we've seen are very tight. So those Dutch auctions are working very well. One of the things it does do, the Dutch auction process does give dealers a chance to compartmentalize their risk as far as how much they want to invest buy. So it has benefited the lead dealers very well. Most of the action has been in the posted selling of the securities. Discount notes and floaters, again, those are the two most active programs that have been utilized through the course of the year. Again, definitely benefiting the lead dealers, but as all the other dealers as well, because again, it lets them take limited risk. And with the volatility in the market space, that's one of the primary things that they're looking for, is to limit their risk exposure when they do purchase securities. Callables have been a little bit harder. As Shara pointed out, some of the premiums have been fairly sizable through the course of the year, although they have come down somewhat. Again, volatility playing into that as dealers gauge whether we want to take the risk involved with callables being on their books. And the reverse inquiry is something that is kind of gained some more prominence in the system with the funding corp. A lot of the state and locals do utilize that to help them match up their funds and how long a time frame they're going to have. So basically what happens with that is they present the opportunity for the system to, we have a certain slug of money. We'd like to have this return on it. Is that something you can work with? And again, that's something that lead dealers have helped to facilitate. Roughly around 16% of the discount notes go through that. And that's the highest utilization as far as reverse inquiries go. Next slide, please. Here we have a very fast moving graphic, if you will, for the year. At the beginning of the year, we had a very inverted yield curve. This is the system's yield curve, but it's fairly representative of what you see from the Treasury market as well. In March of 2022, the Federal Reserve started to increase interest rates. July of 2022, this inversion became what was in place. And all the way through March of 2024, that it eclipsed the longest standing inverted yield curve on record. And that inversion had continued all the way through 2024, almost to the end. Now we've seen with the rate cuts that Shara was talking about, that we've now got to more of a normalized yield curve, which again, from the financial institution's perspective, you take money in short and you lend it out long. That's basically the way they make their bread and butter in the financial industry. When it was the inverted yield curve, that was a little tough sledding for financial institutions, generally speaking. So that bodes well for the system's ability for profitability going forward, again, with the idea that you take it in shorter and lend it out longer at a higher rate. Next slide, please. Some of the risk premiums we talked about, what Shara talked about previously. We do have, as you saw with a limited time frame eclipsed here, you might remember what happened in March of 2023 with the liquidity scare. Again, premiums were elevated then as people's uncertainty kind of took the form of risk premiums. And we've kind of ratcheted down through the course of 24, even since July. And we're looking at some very, very limited risk premiums on the 2 and 5 year bullet products from the system. Again, historically so, and in a number of instances for a number of years. Even the 10-year has come down appreciably since July, if you will. We will see if these continue to hold, though, given some of the dynamics that may occur in 2025 that we'll touch on later. We'll touch on later in another slide. But again, volatility generally denotes higher risk premiums. Although in this case, the GSC market having limited issuance in some regards, in some products, specifically bullets, has fostered a lower risk premium because of the increased desire for those, and because of their limited nature. Next slide, please. And again, this is just a little bit wider graphic to show you where the risk premiums are for the system through the course of the year since we last spoke in July specifically, but also the beginning of last year. You can see that we do have some very, very thin risk premiums being paid on debt securities from the Farm Credit System all the way up to the 5-year point that Shara mentioned. At that point, they do ask for some elevated risk premiums, again, with the uncertainty going into that longer period of time. But you can also see that has come down a fair amount during the course of the year. That may change again with the idea that at one point people were thinking that they knew where the Fed was going. Now that may have changed their perspective with the last statement by Chairman Powell that Charles spoke to, and again some other volatility that may be induced by the change in the political dynamics that we'll talk about in a minute as well. Next slide, please. Here is just a synopsis for, as of the most public information for as of 9:30. Again, days of liquidity are the backup funding for the system if we're unable to access the debt markets, either because of the premiums being too high or just an overall constraint. Again, these days of represent the ability to pay maturing debt. And in the parentheses is basically the first three levels of liquidity as our regulations specify. If you just to remind, 90 days is the minimum. So all the banks are within that confine, and you see the numbers vary a fair amount here. That has been impacted by a bank's philosophy as far as their investment portfolio, and in some cases that the increase in interest rates that we talked about with the Fed from the March of 2022, excuse me, they basically have had some negative impacts on their investment portfolio by that. Next slide, please. But very robust as it stands as it is. So just to go over some wild cards that may be coming into play in 2025 is one would be, and again, Shara mentioned to a point, some of these, change in leadership in the executive branch, as well as the U.S. Senate, potentials for tariffs and change in tax policies, continued deficits, growth in the national debt, a reinstatement of the debt limit at $31.4 trillion, again with a T. So that could potentially bring some volatility into the market for sure, especially as that in the past, as we talked about the credit rating agencies, August has not been a great month for rating agencies as far as their view of the U.S. government, which is linked to the system's credit rating. August of 2011, that was when S&P took down the rating by one notch of the U.S. government. And August of 2023, that's when Fitch did the same thing. So we'll see. And Moody's has already made comments about the negative outlook. So again, if we have a big go round all the way till the end of with this extenuating measures, or basically where the debt limit may be still in play in the latter part of the summer, that could happily be the trigger that takes that last credit rating agency down. Federal Reserve, go to the Federal Reserve here and file card. Federal Reserve monitoring data is the way they've been playing the whether we should decrease interest rates in the future. It's entered a new phase per Chairman Powell, again, as Shara pointed out. Further interest rates looking to limited, if at all, and inflation continues to be stubbornly above the 2% target. Impacts from their political agenda adding to concerns of it being negatively impacted. And then last part with global conflicts would be military conflicts, obviously Ukraine and Middle East, potential for disruption in the flow of oil and other commerce through the Red Sea and Suez Canal, but also potential for escalating trade conflicts resulting from any potential new tariffs. So again, there's a number of things in the air going forward in 2025 that could impact the capital markets, especially with the volatility. Next slide, please. And touching briefly on to summarize, again, helping with Shara's help, overall strong demand for the FCS debt, and again, varies by type, as we talked about, especially in the callable space, a little bit harder to find buyers in that regard, at least without paying a high premium, just because of the volatility and the nature of the market's sense of where it's going. Reversion of the inversion of the debt yield curve. Again, normalized curve. Reversion of the inversion helps the financial institutions generally make their bread and butter. Favorable risk premiums, again, some historically low ones, as we pointed out in that graphic. Ample secondary liquidity in case the debt markets were to have an issue with either charging more than the system would be willing to pay or had seized up entirely. And again, that's a secondary source of liquidity that's well within the regulatory minimums. And then the wild cards we just spoke about. At this point, I'd like to open it up for questions.
Thank you. Thank you. Does the board have any questions of the staff on the material presented? Mr. Hall?
Thank you, David and Shara. I don't have any questions.
Thank you. Mr. Smith?
Just one question, David. Current interest rate scenario, pricing scenario with the system, how competitive are we with the commercial banking world? Are we still maintaining a competitive edge there, or in a decreasing interest rate environment? Does that change?
Well, and at the current juncture, again, they're having to pay for funds just like the system is. So I think it's fairly much commensurate with the commercial banking sector as far as their ability. Again, the system's always had advantages when it came to long-term financing. So that is one place that they still hold a lot of advantages. The GSE market as well. I think that their competitive nature is basically still in line with that, even though after the interest rates have increased with the commercial banks.
And long-term rates, I think, I read that housing mortgage rates have crept up in the last several months. Is that right? Have we seen the same on farmland, on land mortgages then?
Well, as far as the ability to finance those, I mean, the system provides a conduit. If you're gonna stay in business, you kind of have to price out what the market's willing to give you. So, and that has impacted the ability to do long-term real estate financing as well, and increasing the rates there. I mean, that's the cost of doing business. Is again, the funding is basically the primary reason for the loans to be financed. And if they have to pay more for funding, if you're going to match the funding, otherwise you can get yourself in a bad place like the S&Ls back in the 90s.
Mm-hmm.
So you need to make sure you're matching up the funding that you're paying for.
So long-term land mortgages have paralleled what you're seeing in the housing then as well. Okay, thank you. Thank you, Mr. Chairman.
Thank you. I don't have any questions, but thank you, David. Thank you, Shara, for the presentation today. So now please turn to the adjournment tab. If there's no further business to bring before the board, I will entertain a motion to adjourn the meeting.
I move that we adjourn the meeting.
I second the motion.
The motion has been made and seconded. Is there any further discussion on the matter? Hearing none, the secretary will record the vote on the motion.
Mr. Smith?
Aye.
Mr. Hall?
Aye.
Chairman Logan?
Aye, the motion carries. The meeting is adjourned.